Hello, and welcome back to ATA Live. I am John Humphreys from the ATA being the Australian Taxpayers Alliance. Let me see, I normally bring that little banner up for you. Australian Taxpayers Alliance, taxpayers.org.au. Go check it out, see what we're up to. Join if you like. But anyway, keep in touch with us. This is simulcast to YouTube, to X, and Facebook, mostly on the ATA channels, but also on my personal channels, John Humphreys. So if you're wherever you're watching it there, please now give it a like. Stop, pause. I see you. Go on, give it a like, please, and share if you can, and go and follow us on those platforms. Right. So whichever one you're watching on now, maybe tick over to another one: Facebook, YouTube, and X. Go and find the Australian Taxpayers Alliance, and go and find John Humphreys, my personal site, and give us a follow. I think this is also today going out to the Good Source on YouTube. So if you're there watching this from the Good Source on YouTube, hello and welcome. And if you're not, check those guys out as well, run by Dave Pello, a good group of people. So the Good Source is that platform. So this is simulcast, as I said. It's also done live. So you'll see my mistakes in real time, and I will see your comments in real time. And speaking of which, I chat on Twitter and watch on YouTube. I find that strange, but okay. Sure, that would work for me, perhaps, because it gives me two views at once. So not that we're counting. So yes, g'day, Tyrone, the Liberty Tyrant. Welcome back. So today, I mean, I know this is in the lead up to the election, so I did say we'd be talking election stuff. I got to say, I don't know if I'm the only one, but is this election a bit boring? I mean, maybe it's just me. Maybe I have unusually high expectations. But they had a debate on Monday. You guys would have seen that, the public debate between Dutton and Well, I say public. It wasn't televised free to air. You had to pay Sky News to see it. But the debate between Albanese and Dutton, in which I'm going to say, tell me if you saw it differently, but they didn't really say anything. Look, both of them didn't make mistakes. I commented on this afterwards to a political friend. They both put in very solid defensive performances. You know, they just avoided landmines, avoided saying anything, gave the right sort of tap dance and spiel according to the opinion polls. So it was a very defensively successful debate, but that kind of means nothing interesting happened. So there wasn't, I think, wasn't much to report on, really. I don't think it changed anything, right? So Dutton's behind in the polls. He's a couple of percent behind. He's gone down since the election started. It looks like Albanese is going to get back in. He may even get back in the majority government. I'm not saying what I want to happen. I'm saying what seems to be on track. Dutton needed a performance. He needed to do something to change the game. People who like Dutton will probably say that he did that. But if you already liked Dutton, you weren't the audience. I don't know if it changed anything. It seemed that they both did much of a nothing. That's not a real saying, much of a nothing. It is now. This is now a saying. They both did much of a nothing in that debate, which is probably what Albanese needed to do, right? He needed to not step on a rake, and he didn't step on a rake. And Dutton kind of went in and didn't step on a rake as well. Very solid performance, but I'm not sure if that's going to change a vote. Which this election seems to be trending towards, I would say, a result somewhere between 2019 and 2022. Which is a very unexciting and uninteresting. And there's not much good policy depth in this. And I know this is a constant refrain. I say this each time you hear me say it. And I guess this is just the nature of politics these days. There's going to have to be a re-engagement in policy at some stage, hopefully before our next major recession. But if not before, then it'll have to be after. We cannot keep just sliding through, assuming that the policy will right itself, that we can continue with unsustainable policies forever. We can just continue spending more than the government brings in with an aging population while we continue to penalize work and we have no productivity growth. None of that adds up. No policy. That's right. The no policy is the policy these days. So that's going to change at some point. As I want to say in other scenarios, it's either going to change cautiously and carefully because we think about it now, or it's going to change all of a sudden because we go driving this economy off a cliff. Either way, it is going to change, but it doesn't look like it's changing at this election. So I don't know what else there is to say about the actual give and take of politics. Now, I did promise to come to you with new policy ideas from the Australian Taxpayers Alliance, and we will continue doing that. Although I got to say, while domestic politics got boring, or maybe always was, it's been very interesting on the international front. All right, so there's Twitter's exploded. Sorry, X has exploded, but I mean, so is the actual world, so is the media, so is just U.S. politics, and everyone responding to U.S. politics. And people are hopping on planes, flying around the world, trying to get meetings. Of course, I am referring to the Trump tariffs, dun, 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 which has got lots of people arguing. And I thought I would spend a bit of time on that if Australian politics is going to be insufficiently interesting. Let's talk Trump tariffs and trade, because there's a few. Look, I've touched on it in earlier live streams, but it is difficult to explain it without a whiteboard and without enough time. I thought I would have another go at it. And I thought I'd do it in a format of looking at some back and forth discussion on X and just trying to pause and give a bit of background for what some of these concepts and words mean. So firstly, I'll just run us through what's happened, what we've seen in the last week or so. So, of course, Trump announced a series of tariffs on his, what do you call it, Liberation Day, I believe. And people expected him to say something, but it looks like the announcement exceeded expectations because the market responded. Of course, the market already factors in their expectations. So if you do something that perfectly matches their expectations, the market doesn't move. So the market moving isn't about the idea of tariffs. It's about the idea of tariffs being different to what they expected, which maybe that's the first thing to then comment on in general, is that the markets, the share markets, I should say, collapsed in America after his announcement. The share markets then collapsed in Japan and China and Europe, Australia, and the rest of the world. And this created lots of conversation. It got lots of people talking, as you can imagine, and it had a lot of people, many of whom were motivated to dislike Trump, then came out and said, "Look, see what he's done. He's ruined the share market." And there's some truth to that. His announcement was the cause of the collapse of the share market. And this does matter to people who invest. If you're an investor, if you're a trader, but also if you have a superannuation fund, then you are an investor. And so this narrative was, look at the big bad man, Trump, which I don't think it's entirely wrong, but I think it was often used with a lot of motivated reasoning by people who really wanted to say something bad about Trump. And I don't think they were attempting to paint the full picture. Anyway, another group of people responded, sort of the Trump apologists, making the point that, yeah, the share market's down, but the share market's not real life, right? It's a share market. Most of us don't trade the share market. Most of us aren't active investors. Now, many of us, nearly everyone in Australia, is a passive investor via our superannuation fund, but most of us don't follow our super fund that closely. Most young people don't care about their super fund that closely. And realistically, the ups and downs in our super fund, it's by the time we end up accessing it, for most of us, we won't remember this blip. So that response also, I think, is basically true, but also I think kind of misses the point. So both of these, I'll see if I've got it here somewhere. Where did I write this? Yep, share market's falling in response to Trump's tariffs. The mainstream media is playing up drama, red ink everywhere. Your super balances are down, or whatever they call super balances in America. And the Trump apologists are saying, "Nah, mate, don't worry about it, because the share market's not real." Now, both are true, but both are kind of just talking points, right? So the important thing to note about the share market is not whether it's up or down because you have shares in it. Fine, but most people who have shares in it are the fancy rich people. Screw it. Now, I do actually care about rich people still. I don't want us to just piss on their graves because I don't want to put them in graves first, or piss on their graves just because they're rich. But that's basically never my motivation in trying to work out what is good economic policy, right? So, and you don't have to care about rich people or traders at all to care about the share market. What's important about the share market isn't that someone lost money. Screw them. Let's just say we don't care about that at all. Screw them. What's important is, why is the share market going down? It's going down because people now expect businesses to shrink. The share price is it's a price of a business. It's the price of a business. Sorry, getting a phone call. Get rid of that. And that price is basically created by an expectation of future profits. I mean, that's basically what it is. The price of a business is the present value of the expected future profits, adjusted for risk and a few other things. But that's fundamentally what you're looking at here. And the main thing that changes the share price is a change in your expected future profits, right? So if you're seeing profits, sorry, keep getting phone calls. Very popular tonight. So if you're seeing the share price go down, what that's telling you is, oh, fine, someone lost money, screw them, we don't care about that. But what it's telling us is people who are putting their money where their mouth is are seeing that profits are going to likely go down in the future. Now, is the share market perfect? No, by no means. It'll jump around. But I mean, that's fundamentally what it's pointing to. It's pointing to an expectation of smaller businesses in the future, and smaller businesses, smaller profits, smaller tax revenue for the government, smaller benefits for the people who own business. But a shrinking business, that's fewer jobs, and what jobs they can pay with lower wages. I mean, you do not create prosperity by having fewer businesses and those businesses becoming smaller, right? And that's what it's indicating about the future. So it hasn't happened yet, right? The share market going down looks very dramatic if you own shares today, but it's not really a cost today. It's a prediction. It's an expectation of a cost in a year's time. And that's why we should care about it. Not because we're, shedding tears for the traders, but because we want to know if we're going to be in a recession in a year's time. We want to know if wages are going down in a year's time. We want to know if businesses are going bankrupt in a year's time. And that's why the stock market is a very relevant indicator, right? Not because we care about the traders. So that's an important thing to note here. As it says, share price is basically a prediction about future profitability. Falling share market suggests businesses are about to shrink. I mean, and that's why that's why it is something to note, right? That is why it is something to worry about it. But all of this is, again, to note, this is just a prediction, right? This is all just a hypothetical at the moment. A share market is predicting what could happen in the future. It hasn't happened yet. I think my internet's probably fading, so I'm going to reset it. I'll be back in 3 seconds. Famous last words. Why, thank you, Tyrant. It's one of the nicest things anyone said to me today. So, and that is also true. This discussion of super, it may all just be a joke by the future, but you're quite a young man, so you're definitely not worrying about it at the moment. But anyway, this is all to say that the drop in the share market does matter, but not for the reasons that the media was shrieking. And it hasn't happened yet, so a lot can change, right? At the moment, this is a hypothetical future scenario. Trump could backtrack. Indeed, he already has. Or you'd say he's successfully negotiated, whatever you want to say, to change direction, right? Let's try to keep it value neutral in the language. So Trump could change direction. The courts or the Congress could overrule him, and we don't know how other countries will react. So the future hasn't happened yet. The share market's a prediction of it, but it hasn't happened yet. And we saw, of course, today Trump came out and has paused for 3 months, most of the tariffs for most of the countries. So he's doing 10% across the board on everyone still, but he's taken away all of the extra top up 20, 30, 40, 100% tariffs on all of the countries except China, right? So now I think he's had a change of heart, change of tack. Instead of fighting the world, Trump has decided to just take on China. So that's an interesting change. And since then, we've seen the markets bounce back, right? And that, who cares about the money people make in the market? That's not the point. It's telling us the people who put their money where their mouths are now predicting that many of these businesses aren't going to shrink that much. They are going to stay successful. They are going to stay profitable. They are going to continue hiring people. And so that is a good thing to see with those businesses. But that's why it matters, right? So that's the first thing. Why do we care about the share market? But anyway, running away from that for a moment. So just going through the history, Trump announces it. There was a stock market crash. There's gnashing of teeth. It was supposed to be, I think, yesterday were all the top-up tariffs. There was a 10% tariff for everyone, and then a bunch of top-up tariffs. And the 10% is not about reciprocation. I think that's just a revenue raiser. We'll get to rationale in a second. And the top-up tariffs were called reciprocal. And this is an important thing to note if you want to discuss what's going on here. They're called reciprocal tariffs, but they had nothing to do with the other countries' trade barriers. Right? They had nothing to do with the other countries' tariffs, but then you might say, oh, these non-tariff barriers. But they also had nothing to do with the other countries' non-tariff barriers. Right? It had nothing to do with the other countries' internal subsidies or environmental regulations or their quotas or all of these other non-tariff barriers, which are all very well known in the world of trade economics. So first thing to note, Trump's reciprocal top-up tariffs weren't reciprocal as in if you tariff me, I'll tariff you. They were reciprocal in the sense, and which isn't a real sense, that if the US had a trade deficit with a particular country, then Navarro, the trade advisor to Trump, thinks that's bad, and there must be something bad going on in the world. Who knows what it is? It's just bad, and so we'll put a tariff on them. So that's not a reciprocal policy. It's just we don't like the fact that we have a trade deficit with you, so we'll put the tariff on you. So that's the initiation of the tariff. And then the issue there, the open question is which countries are going to retaliate to that moot point because Trump has backed away. So open question, has he backed away for good or has he backed away for 3 months? Because it's, which, I'd be curious what people think here. But at the moment he's saying that he's backed away for 3 months. Now, I put up a poll. I only put it up recently on X. It's relevant for this question. Whether Trump is backing away for good or whether he's going to reimpose the top-up tariffs, to be able to guess at that, I mean, who knows the mind of Trump? He's an enigma wrapped in a riddle, wrapped in a mystery, as I believe Winston Churchill once said about the Soviet Union. But it is, I mean, people are speculating because it makes a big difference on what we think is going to happen next. And a lot of people have a lot of money to win or lose, and politicians have a lot to win or lose, and commentators have a bit to win or lose, if we can predict that correctly. So I'd ask you guys, so what do you think Trump is trying to do? So I put up this poll. Let's see if I can find it. Well, that's not it. That's the last one. What is Trump trying to achieve with this? So I think a lot of the optimists out there, a lot of the people, I guess, like me, who is predisposed towards liking Trump, but am very skeptical about his tariff policy. We are either believing or hoping, I think this is a bit of a hope over reality, hoping that it's a bargain. It's a bargaining position. He puts on the tariff, he negotiates a better deal. And he's actually angling to negotiate for more trade. He puts on a tariff, he goes back and says, well, I'll cut my tariffs again if you cut yours, and then you end up with a win-win outcome. I hope they're right. I suspect they're wrong, but I hope these people are right, these 23.8% so far. If that's what he's going for, then, perhaps we won't see these tariffs ever come in. But if it's one of the other reasons, then this 3-month reprieve may be something else. So look, I'd be curious to know what you guys think. If you want to just jump onto X, John Humphreys 99, I can be at the top of my page. I'll be curious what everyone thinks. So the options I've given here is one, which is the hopeful one, the libertarian Trump supporters are hoping for, bargaining for free trade. The other options out there is that he could be angling to raise revenue. I mean, tariffs are a tax. It's a tax on the American consumers. They have to pay more for foreign goods. And that's fine. That's one way to raise revenue. And that's kind of, I would argue, one of the better reasons to have a tariff if you're going to have a tariff. And then there is the argument that I think is the true one for Trump. It's certainly the one everyone's talking about these days. It's to reduce imports. Or I should say, perhaps more directly, what Trump seems to be saying is to reduce the trade deficit. Because as I said before, Navarro, the way they framed these retaliatory tariffs in the first place was that we need to retaliate to a country if we have a trade deficit with them. So it looks like that might be the motivation as far as I can tell from their rhetoric. And there is a fourth option here. It's a kind of like a 4D underwater chess option, that it was to reduce bond yields at a time when the American government was going to have to turn over a lot of their debt. And that maybe gets a bit nuanced. It, of course, very much didn't happen. But it's the idea behind that was you announce a bunch of radical tariffs, the market tanks. I mean, they've got to have predicted that the market would tank. When the market tanks, the stock market, the share market, people get spooked. They expect a recession. What do people do in times of recession? They buy bonds, right? Bonds are supposed to be safe. They rush to safety. And if everyone buys bonds, the price of bonds go up, therefore the yield of bonds go down. And that's basically that the bonds are linked to the interest rates. So you're going to have directly for the US government's perspective, the bond yield is the interest rate they'll pay when they borrow to cover their budget deficit. So if this announcement, the tariff announcement, spooked the markets and suddenly bond yields shrank, the US government was about to have to pay 4% on their borrowing, but they spook the market and suddenly bond yields are at 2%, and then they borrow the money, and then the bond yields can return later if they like, but they've already borrowed the money at 2%. That was I saw that suggestion being put out there, that was the 4D underwater chess move that the Trump administration was trying to achieve. If that was the goal, it backfired quite substantially. You may have seen, it's been reported that one of the motivations for Trump changing direction today, when he's delayed a lot of his tariffs, was that the bond market went in the exact opposite direction. I think I have that one here somewhere. Let me bring that up. Yeah, here we go. Let's see if I can bring that up for you. The US 10-year Treasury. So this is US borrowing for 10 years. And this is just over the last month. It was over the last month. I've changed it now. And you can see going along here, humming along at a bit over 4%. And then Trump announces his policy here. And the bond market goes down, exactly as you'd kind of predict in the normal world. But then you'll see what happens here. And I think it's only on the 6th of April. The bond market recovers. It ends up spiking higher than it has been for a while. So let's see. That's higher than it has been since interest rates were much higher. All right, so they drop interest rates, the bond yield goes down, makes sense, goes down as he announces it, and then spikes back up, which is the exact opposite of, wait, have I got that cursor there? Go away. Which is the exact opposite of what they might have been hoping to achieve, if that was the strategy. If these 9.1%, if they were correct, if that was the strategy, it didn't work out as expected. And what that does then is that bounce up, that increase in yields, a couple of things. One is it just increases the amount that the US government will have to pay to borrow money, which the US government borrows a lot of money, right? I mean, they have a massive budget deficit. We talk about deficits in this country. They've got a massive budget deficit, and they've got to roll over massive debt, and they have to roll it over. There's new debt coming up to roll over every year. So if you increase the interest on that, it's going to bite. So that's one thing. The other thing is, why would that happen? Well, we don't really know yet. It could be the Chinese were selling off bonds. It could be apparently there's a Japanese bank who went into insolvency and they might have had to sell off bonds. Or it could have been that the market started to expect stagflation. So if they started to expect that we were going to have a recession and inflation, then that would also potentially decrease the demand for those bonds and push up the bond yields. So whatever it was a very bad sign, right? It was a bad sign about expectations for the future, and it was just bad in the short term for the US government to be able to borrow money. And it might be, as is reported in the media today, it might be that was one of the main motivations of Trump to introduce his 3-month delay on the policy. Just give me a second. I wish this was right. I should have put that up as an option. You can only do 4 options on X. But Vance was talking in Europe, of course, about how real allies would have free speech. I don't know if that's what you're referring to, Lyndon, but there is sometimes the talk about the tariffs won't apply to a country if they have free speech. I wish that was true. I hope that's true. I mean, we should talk it up because we should have free speech. And I would love it if someone pressured our government into accidentally doing the right thing. I suspect that's not the motivation. I suspect the motivation is this reduce imports option, which is worth unpacking a bit then. Because it is, look, I'd say there are potentially 5 reasons. I'll say this before I get into unpacking this protection argument. There's potentially 5 reasons to have sort of Trump's tariff policy. One is the one I've mentioned already there, that you could be trying to manipulate the bond market. That gets very esoteric, very pointy-headed. It's a bit, most people don't follow that sort of nuance. But if it was a short-term play to trick the bond markets into lending the US government money for cheap, maybe you could call it tricky or sneaky, but fine. I mean, that could be a good economic play. I mean, that's fine. If that's the play, it's a short-term play. It's been done. It didn't work. But if that was the motivation, fine. It's not the end of the world. Another possible motivation is the one I mentioned before, that all the sort of libertarian, the free trade people, the free market people who support Trump are hoping, which is it's all a negotiation. It's a negotiation to get other countries to do the right thing. Maybe it's a negotiation tactic to get them to pay for their own defense, to introduce free speech, or to cut their own tariffs. Good, good, and good. I hope so. I hope that's the motivation, that it is about leverage. And if it's about leverage, then great. Great policy. If it's about manipulating interest rates, meh, didn't work. It's not the end of the world. There are some other possible reasons. One is it's a policy to raise revenue. Right. So that's that argument. I think I've discussed this before. That's not a crazy argument. I think a lot of free traders, and I come from a free trader background. One of my first jobs was consulting for doing consulting work, often on trade issues. And at the time, I wrote a couple of books on trade and on, broadly speaking, I guess, the virtues of free trade. So I come from a bias towards free trade. I'm one of those cliche free market economists who supports free trade. But the argument for getting some money from tariffs, some revenue from tariffs, I think has some legs. The reason isn't that I think tariffs are a great idea. The issue is I think all tax is a bad idea. I've discussed this before. Tariffs are a tax. I think pretty much all tax is a bad idea. But if we live in a world where tax exists, then it's reasonable to have the conversation about what is the best tax mix. Maybe I should say the least worst tax mix. And at the moment in Australia, we are exorbitantly over-reliant on income taxes. Our income taxes are way too high. And so there's a reasonable case to be made. I'm not sure if I'm fully on board, but I don't think it's crazy to be made that, all right, put on this 10% tariff like Trump has, maybe 5%. But if it's a low enough tariff, it won't cause too much damage. You'll raise some money and you can cut other taxes. Right? So that's, if the argument is we want tariffs for leverage, great. If the argument is you want tariffs to raise a bit of revenue, fine, reasonable enough. If it's to manipulate interest rates, didn't really work, but fine, it's not the end of the world. Now, one thing to note about the revenue one is if you increase the tariffs too high, firstly, you will start creating very serious consequences, which we'll get to in a second. But secondly, you won't raise as much revenue, right? If you increase tariffs too high, you actually won't raise revenue, because if the tariffs are high enough to stop trade, obviously, if a tariff stops trade, it doesn't create any revenue, because the tariff is a tax on trade. If there's no trade, there's no tax on trade, there's no tariff revenue. So the idea, if you want to use tariffs to raise revenue, you are still arguing then for a low, maybe medium at best, but sort of a low consistent tariff, somewhat like Trump's 10% tariff across the board. So my suspicion is his 10% tariff across the board is designed to raise revenue, and all of his top-up tariffs were designed to stop imports. And that's probably how you'd go about it, right? So that makes some sense. But anyway, those are 3 rationales we've had so far. Leverage, great. Interest rates, meh. Revenue, meh, fine. Another one that you often hear is security, right? And I think this is another one that has, the argument has a lot of legs, but I think it's often misunderstood. If the goal is security, whether it's national security or food security or just oil, security of access to things like oil or pharmaceuticals, then that is something that people should be worried about. But that concern doesn't lead to not having trade, right? I mean, indeed, if you didn't have trade, you would actually have less security, right? So if you could source your food from either Australia, New Zealand, Indonesia, America, that's 4 possible places to source your food. If any one of those places gets struck by locusts, you still have 3 others. If you can only source your food from one option, Australia, that's less diversification. That's less food security, right? So what you need is enough different options, and that's the same thing with many of the other things we import. You increase your security by ensuring that you've got options and trying to make sure those options are amongst friends. Right. So the idea that we need to worry about security with trade is a true thing to say. It's a realistic concern. It's a legitimate concern, but it doesn't justify trying to not have trade. Right. It justifies being concerned about being overly reliant on potentially hostile actors. And that is a genuine geopolitical sort of strategic concern that our politicians should be worried about. Are we over reliant for key products? Are we over-reliant on potentially hostile foreign actors for key products that we are going to need? And if we are, how can we diversify that? Not how can we create everything ourselves? That wouldn't make us more secure. It would make us significantly poorer. You're never going to be perfectly capable of looking after yourself. So you're going to have to rely on someone. And if you try to only rely on yourself, you've actually got less diversification, less ability to fill a gap when you need to fill a gap. So the security argument is a really good argument to worry and do something. It's not really an argument for not having trade, which brings us to finally, and this is kind of like the point I've been driving at very slowly, very cautiously, the main argument, which is that tariffs are there to cut imports, right? And I think a lot of the other ones, I think, are fig leaves for this. I think this is the genuine reason, right? And people say, oh, no, I want tariffs because I care about the environment, or I want tariffs because I need to raise revenue, or I want tariffs for security reasons. And then they end up often just arguing for across-the-board tariffs to cut trade. And sometimes they'll admit that's their rationale, and sometimes they won't. But I think for a lot of people, I think Trump's just admitted it. Navarro's just admitted it. And I think this is the argument for tariffs. It's the only one of the 5 I've mentioned that is just wrong, right? It just doesn't stack up. It doesn't make sense. And if you disagree, please bear with me for 10 minutes while I try to unpack this, or 5 minutes. I'll try and do it quickly while I unpack this. So firstly, as I unpack it, remember, security considerations, fair. We should worry about it. Revenue issues, fair. We should talk about it. Leverage, great if you can make the leverage work. I'm just talking here about the argument that tariffs will actually make us richer, because if we use tariffs to protect ourselves from foreign trade, we'll have a smaller budget deficit. Sorry, it's a smaller trade deficit, and a smaller trade deficit means we're going to be richer. It's that specific argument, which is, I think the technical term is utter bullshit. I mean, it's just not true. So you have to stick with me for a second while I try to unpack this. The first, I'm going to use some jargon, and I don't have a whiteboard behind me, but stick with me. The total amount of money that flows in and out of a country nets to zero. Right? So we can use Australia as an example, or America if you like. I'll use Australia for now, and we can jump countries if we need to later. The total amount of money that flows out of Australia in net terms is zero. All right, and you can think of it this way, if it helps to normalize it. Australian dollars can only be spent in Australia. All right, so if Australian dollars go overseas, they end up coming back to us. Right, because what they'll do, someone overseas, they'll take that Australian dollar and they'll eventually buy something from Australia, or they'll lend it to an Australian. It'll somehow get back to Australia. Or if they don't want to use it, they will change it on the exchange rates. Right? They'll go and change it on the money markets, but they'll only change it on the money markets to someone else who then has to use the money in Australia, right? Because you can't try walking into a shop in America and using Aussie dollars, right? It's not going to work. I mean, there's probably a few countries that do accept it, but on the whole, for most countries, in most situations, your currency is used in your country. If it leaves your country, it will come back. So that's a way to conceptualize it. But if you don't need to conceptualize it, if you're happy doing the autistic maths thing, the formula is the current account plus the capital account equals zero. There are different ways that money flow in and out of a country. And we split them into 2 different accounts, right? The current account and the capital account. And I'm going to do some oversimplifying here, because this stuff's normally taught in a couple of lectures, right? That's what, 2-4 hours. We've got much less time than that. So I apologize for the nerds out there that already know some of this stuff and are going to jump up and down and say, that's not quite right. Yes, I'm simplifying to some degree here by necessity. The parts I'm leaving out don't fundamentally change the story. So money flows in and out of a country for two reasons: the current account and the capital account. The current account is basically driven by the trade balance. And that's where we get our relevant statistic for today, the thing that we're all talking about now. The trade balance. If you have a trade deficit, you can say money is flowing out of your country. Trade deficit will often be associated with a current account deficit, which means on the current account side or the trade side, you've got money flowing out of the country. And money's flowing out of the country because you've got more imports than you have exports. So that's the trade balance. A lot of people understand this trade balance. But just to dumb it down even further, you've got imports when you're buying stuff from overseas. You've got exports when you sell stuff to overseas. And if you buy from overseas more than you sell, i.e. your imports are greater than your exports, then you'll have a trade deficit, meaning a current account deficit. And that's all true. And that's, people like Navarro and protectionists will get that far in the analysis. But as I said at the beginning, the total amount of money flowing in and out is zero. So there's another side. There's another account. What is that account? That's the capital account, right? So if we have a trade deficit, we're going to have a capital account surplus. And what does a capital account surplus mean? Foreign investment. All right, so we've got foreign investment coming in. And this is the basic rule. It's the capital account that drives your current account. If you have foreign investment, this is the crucial sentence. If you have foreign investment, you are going to have a current account deficit. Net foreign investment, right? More foreign investment coming in than going out. So, of course, we also invest in other countries. But if you have net foreign investment, if money is flowing into Australia to invest in Australia more than we invest in other countries, if we have that, capital account surplus in the jargon, or, a lot of people wanting to invest in Australia, you're going to have a current account deficit. You have to. That's just how the maths is. Right? The current account deficit equals a capital account surplus. The current account surplus equals a capital account deficit. They just offset. They're equal and opposites. So Australia is a country that attracts foreign investment. So we are going to have a current account deficit. Often. I mean, we don't always attract the investment, but America is a country that attracts a lot of foreign investment. So they're going to have a current account deficit, which is often mostly manifested as a trade deficit. The two things aren't quite the same, right? So current account deficit also factors in incomes and remittances. Don't worry, the main thing driving the current account deficit is normally the trade balance. So this idea that, oh dear, we have a trade deficit. All right, firstly, is the question, it's not obvious that that's a bad thing. But secondly, you are going to have a trade deficit while you are a net capital importer. So this goes to the point that Navarro and others were making before. If their goal is to decrease their trade deficit, it's just not going to work, right? Because the trade deficit isn't caused by low tariffs or high tariffs. The trade deficit is caused by the fact that they're a capital importer. And let me unpack this a little bit more, because I've just asserted a few of these things. You might be asking, well, why is that true? Why? It doesn't have to be true. All right. Imagine a scenario where this is a good way to build it up, right? This isn't reality, but it's a good way to build up to reality. So imagine a scenario where there was no capital movement. So the capital account equals zero. There's no foreign investment coming in or going out, or if there is, then it's exactly offsets, right? So there's no net foreign investment. The capital account is zero. If that's the case, as I said before, then the current account would be zero as well. So our exports would equal our imports. There would be a trade balance, perfectly balanced, exactly as Navarro and various others say they want. Well, why is that the case? Well, consider the scenario where imports increase. All right. So how would this work? Imports are increasing. You had imports and exports, both perfectly balanced at $100 each, say. And then suddenly there's more imports. Well, the consequence of that is that if you've got to buy the foreign good, you have to pay them in their currency. Right? So if you might not have to, because you're sitting at home like in a shop. So someone else has done this for you. But the importer, to get that foreign good, they had to first buy the foreign currency. So say we're buying something from New Zealand, right? And then we want to increase how much we buy from New Zealand. The first thing you need to buy is New Zealand dollars. So you buy the New Zealand dollars so you can buy the New Zealand product. Fine. But if there's an increase in demand for New Zealand dollars, but there's no increase in supply of New Zealand dollars, because the Kiwis don't want any more Australian dollars yet. In this scenario, we're just saying the imports increase. So if there's increased demand for New Zealand dollars, but no increase in supply, that's going to make the New Zealand dollar appreciate. It means it's going to make your dollar depreciate. If there's an increased demand for imports, it makes your dollar depreciate. But then what does that do? If your dollar is depreciated, if it's worth less, that means imports now look more expensive. So people will buy fewer imports, and your exports will look cheaper. So foreigners will buy more of your exports, and the currency will keep shifting until that import and export come back into alignment. Because it kind of has to. I mean, if no one is willing to supply New Zealand dollars, you have to keep bidding up the price of New Zealand dollars until they're willing to supply it to you. And at that point, they have Australian dollars. They have to do something with it. So they have to buy an Australian good or lend it to an Australian. So these things, so if there was no capital account, which I cheekily just brought the capital account back into my example, but ignore me that. Forgive me that, I should say. If there was no capital account, if you increase your imports, you're going to increase your exports. And crucially then, on the other side, very relevant to Trump's discussion, if you decrease your imports, you are going to decrease your exports. And this is the thing that I think is missing in a lot of this conversation. People say, oh, we have a horrible trade deficit. We need to fix it. So we'll decrease imports. Yep, but that's going to decrease exports. Because if you decrease your imports, that you are demanding the foreign currency less. The foreign currency is going to go down. Your currency is going to go up. When your currency goes up, that means foreign goods are cheaper. So now you're more willing to buy those goods. So you might have put a 10% tariff on it, but if the foreign currency went down, if your dollar went up compared to it, it only seems 2% more expensive. So you don't cut back your spending that much. And then also your exports are more expensive. So foreign countries don't want your exports as much. All right, so this is the only way to get out of this trap is to reintroduce the capital account, which is goes back to the old point. If you really want to adjust this, if you want to adjust your trade balance, you can't do it by playing around with tariffs. You can only do it by adjusting your capital account side, which if that's their goal, here's the thing about this. If their goal is to reduce trade deficits, tariffs basically haven't got nothing to do with it. They need to just restrict capital flows. Now, whether they should do that is another question. But I mean, it's a legitimate can of worms to open. We could dive into that, but they're looking in the wrong place, right? Because they've got a floating currency. I mean, I guess the US could look to fixing their currency, pegging it to gold, but that's going to open up a whole other can of worms. And I realistically, I don't think that's what they're looking to do. So it's not too relevant to this conversation. So this is the big imponderable here. If the goal of tariffs is to decrease the trade deficit, it alone won't achieve that. Now, here's the kicker. This is like the accidental byproduct. The tariffs will change the industry that's successful inside the country that puts on the tariffs. All right, so that's true. What it will do is it protects import competing businesses, import competing industries. If you're in an industry in your country that competes with imports, the tariff kind of protects you. It decreases your competition, right? Everyone wants that. Everyone in business wants to have their competition sort of taken away, sort of taken into a dark room, disappeared. So yes, it decreases the competition on import competing businesses. And that helps import competing businesses. Those import competing businesses can now charge more. They can put their price up. They'll make more money. They can employ more people. So the consumers are still screwed, right? The consumers still have to pay more. But those import competing businesses will be able to hire more people. Great. Hallelujah. That's the whole point, right? That's the goal of the policy. And it will achieve that to some degree. But once you remember what I said before, yes, it decreases imports. It also decreases exports. So your export industries now will be selling less. So they will be shrinking and they will be hiring fewer people. So what this policy does is it shifts resources, it shifts workers, it shifts profitable opportunities away from your exporters and towards your import competing industries. The thing you need to remember is exporting businesses tend to pay higher wages. They make more profits, they grow quicker, and they pay higher wages. So we're shrinking the high-paying jobs so that we can grow the lower-paying jobs. by definition, I mean, these low-paying jobs, they already could exist, and they don't because they're outcompeted by the higher-paying jobs. I mean, the higher-paying industries. So by definition, the export industries are more profitable, right? When you expose everyone to competition, they do better, they thrive, and they are able to then pay more. So one of the consequences of this shift is you protect the import competing industries, you hurt the export industries. And that second part, a lot of people don't seem to realize because they just think you can cut imports without cutting exports. You can't, right? A tax on trade is a tax on trade in both directions. So you're going to cut imports and cut exports and lower wages. And one of the consequences of that could be to put your country into a recession, right? Sort of decrease a lot of businesses, decrease a bunch of wages. But here's the kicker. Like this is what I was driving at too when I brought up this example. I mean, all of that was worth saying. But if we go into a recession, if there's fewer investment opportunities, it might be that fewer people want to invest in America. I mean, it might be if we introduce tariffs in Australia, it might be that then fewer people would want to invest in Australia. And it's that change in the capital account that might actually mean we have a smaller trade deficit. So, I mean, if Trump was able to bring in his policy without a recession, it will not achieve his goal. The tariffs don't achieve a cut in the trade deficit. The only thing that can achieve the cut in the trade deficit sustainably is to decrease foreign investment. And he might accidentally achieve that if he pushes his country into a recession, which of course shouldn't be the goal of anyone. You shouldn't be, I've got a goal that we attract less foreign investment by making ourselves poorer. That'll get it, that'll stick it to the man. Now we're so poor, no one wants to invest in us. I mean, that's not a goal anybody should have. But it is an ironic sort of twist in the tail. You say if your goal is to decrease your trade deficit, you might accidentally achieve that by just hurting your economy. So that's this issue of the virtue of tariffs for protection. Now, I'll just repeat what I said earlier for the first half hour of this. There's a whole series of rationales to have a tariff. And 4 out of 5 of them are worth discussing. 4 out of 5 of them are worth unpacking. Whether you're doing it for leverage, you're doing it for revenue, you're doing it for security reasons, you're doing it to potentially try to manipulate the interest rate market, the bond market. All 4 of those conversations worth having. If your goal is to decrease imports, you're going to decrease exports too. That's the thing you've got to realize about this. And these export industries pay higher wages. You're not protecting jobs. You're not protecting wages. That is not what is being achieved here. You are protecting some jobs at the expense of other jobs. Now, there may be cases where even that you might want to do. So maybe I should sort of backtrack on the forcefulness of the rejection of the concept. But if that's the case, what we need to do is be honest about it and say, look, specifically, we're trying to save these jobs in this town. We as a country are willing to sacrifice some of our wages. We're willing to sacrifice some of our jobs so that we can protect some specific jobs. And if that's the goal, and look, maybe there are towns that we want to heritage list. We want to heritage list their jobs. This is basically what the French have done with agriculture. Right? A lot of French agriculture just doesn't make much sense anymore. They're not good at it. But the French have decided that they very much like having farmers. And so the farmers are just a work for the dole scheme in France. We could do something similar, right? So if that's your goal, if there's an industry that we want to preserve for heritage or posterity reasons, I guess you could protect that industry. But let's just be honest about it. We are making other people pay the price in terms of lower wages and fewer jobs. And if you think that heritage listing is worth it, then okay, but let's do that conversation honestly. Let's not pretend that we are protecting jobs there. We are protecting a little slice of history, which might be nice to do, but we're doing it at a large economic cost. So that is the rant. I'm going to go just quickly and check. I saw someone saying answer this, and then I didn't see anything coming in after the this. Sorry. So Nazcar, maybe I missed your question. Should we keep tax levels, cut government services to pay debt, and once we have no debt, then cut taxes? All right. Total segue. I love it. I disagree. I mean, I think we do need to cut back on government spending. I think that's unambiguous. The current spending level is on a trajectory that is just unsustainable, right? Because it keeps growing at faster than inflation, faster than population, even faster than wages in a lot of these programs, faster than GDP. Especially health and age services are growing consistently faster than GDP, which is just unsustainable. You play that out until the end, your country implodes, right? It can't exist. So we do need to do something about spending. I think we need to do it immediately. I don't know how we can get the attention of the politicians, which is, I guess, more to say how we can get the attention of the voting public, because the mainstream politicians just follow the voting public. I wonder about this frequently. I come here to rant at the computer, hoping to speak to you wonderful people with one of the goals to try and encourage people to realize the spending trajectory we're on is unsustainable. It has to change. We have to address it at some point. And you're saying maybe we should address that first, and once we've addressed that and paid debt down to zero, then cut tax. I think we need to cut tax at the same time, or just cut whatever you're able to cut, because it's in politics, you're not always able to do everything perfectly. But the reason I say that is, firstly, our high taxes are one of the things holding back our productivity. Right, there's several things, right? The high cost of energy, the high cost of sort of regulation, which is like a tax without revenue, but it makes the bureaucrats feel good, and the high level of especially income taxes and some sort of transaction taxes that we have as well. All of these things are holding back productivity, and productivity has been stagnant for 8 years. And it is a genuinely growing economy that enables an economy to sustain a lot of difficulties otherwise. If you're growing, you can grow your way out of trouble. Look, a small amount of debt isn't the end of the world, right? The problem with debt isn't that we have any. The problem with debt is how quickly it's growing and how there is no end in sight of it growing. So if we have a path to be able to get debt under control, it's not necessary to get debt down to zero before we can start cutting taxes. And I would argue that if we started cutting taxes now, we could get productivity rolling. Now, then we have to get spending under control as well. So that part of your comment is absolutely true. But we don't need to wait until we've fully solved the debt problem. Indeed, and everyone says this, and there's some truth to it. But if you can get your economy growing quickly enough, if you can get your economy growing quicker than your debt, then your debt to GDP is going down. I'll say that again, right? If you can get your economy growing quickly enough through productivity, not population or participation, right? Through the proper way to get the economy growing, which is productivity, not cheating by just importing foreigners or making everybody work at midnight. But if you can get your economy growing fast enough, as long as it's growing faster than debt, if your economy is growing at 3%, productivity growing at 3%, and debt growing at 1%, debt is technically growing, but debt is technically growing, but debt as a percentage of GDP is actually shrinking. Now, everyone says that, and a lot of people, when they say it, they're using it to sort of smuggle in a justification for, therefore, we don't have to cut spending. I disagree with it. Our spending trajectory is unsustainable. We have to cut spending. But we have to kickstart productivity. And the most politically achievable way to do that is income tax cuts. We should slash regulation, and we should get energy prices down. But we also need to cut income taxes to get the economy, get productivity rolling again. So anyway, good question. Segued nicely from the rest of it. Any thought on BRICS? Yeah, look, I'm not convinced that India and maybe Brazil at the moment, but I'm not convinced all of those countries have a long-term rationale to stick together. It's a coalition of convenience on some issues. I certainly don't think India's all in. Russia will come and go at its convenience. Brazil under Bolsonaro, I don't think was in. They're probably back in now under Silva, or Da Silva, whatever his name is. But it's not the BRICS, I think, so much to look at. They're all kind of either cheerleaders or non-cheerleaders for China. So I think it is worthwhile. I mean, this is a good segue. It's not what you asked, but I'm going to use it to, very political of me, right? I'll use your question to answer the question I want to answer. How could China react? Because as you would have seen, Trump's tariffs, all of the top-up tariffs have been wound back. We've still got the 10% tariffs of anyone, but the top-up tariffs have been wound back on every country except China, right? So there is potentially now, we're shifting from America starting a trade war on the world, which I think would have ended up looking very messy, to America having a trade war with China, which potentially leans into the security argument. that we were having before. There's a much greater rationale for specifically country by country, issue by issue, picking a trade fight. I mean, it's still going to come at a cost, right? We still have to just be honest about it. It's going to come at a cost. It's going to hurt. It's going to be higher prices and lower wages, but sometimes that's worth it. I mean, that always has to be the argument. If someone wants to make the argument for tariffs, the honest way of doing it is say it's going to have lower wages. We're going to have lower wages and higher prices, but it's worth it because X, because we need to raise the revenue, because I'm worried about the security issue, because I want to sort of heritage list this weird old industry that would otherwise go out of business. But we need to admit the cost. But with China, at least you can more understand the rationale if they're worried about security considerations. It does raise the fascinating question of what China does next. Because China is 15% of China's exports go to America, right? Which is only 15%. So 85% of their exports are fine. But I mean, 15% is still a big chunk. America drastically cutting back on imports from China. That is the way America knows that they can sting China. It's worth considering which ways can China sting America. So China's come out and said they're going to put tariffs on some American products. Sure, I guess that'll hurt a few American products. But I think something like 5% of American exports go to China or something. So it's not going to sting America as much as America is going to sting China. But that's not the only thing China can do. And the immediate thing that people often think of, and it's true, it's worthwhile considering, is that China owns a lot of America's government's bonds. And that means that's another way of saying China has lent a lot of money to the US government, right? So they own their bonds, they've lent them money. Saying they own bonds is just kind of like a wanky insider way of saying I lent them money, right? But you own the bond, which means you own the fact that they're going to repay you someday. Now, that comes with costs and benefits. The thing that some people worry, and it may have just happened in the last week or so, is if China goes out and dumps those bonds, then if they try to sell all those bonds at the same time, it basically drives up the interest rate that America will have to pay on their debt. All right, so it'll push down the price of bonds. When the bond price goes down, the bond yield goes up. You don't have to understand that. Just trust me. Or you could just Google it later, but it is true. So if China dumps US Treasury bonds, the bonds they own from America, from lending money to America, then it will push up the cost of American government borrowing money. So if China just waits for the moments when America is refinancing and goes around strategically dumping sort of $100 billion here and $100 billion there, soon it adds up to real money, they could cause a bit of damage. The thing to note about that is that China could hurt America, but it would hurt China too, right? The way that if China dumps bonds, which is a commonly discussed thing that China could do to hurt America, by definition, they're selling the bonds cheaply. That's how they hurt America. But that means they hurt themselves. They're selling an asset that they have for cheap. If they take a $100 bond and sell it for $90, sure, that screws over America, but you just sold a $100 asset for $90. 90 is less than 100. I mean, you're hurting yourself as well. But I mean, that's kind of true of all of these things. America hurting China on trade is going to hurt America. If China tries to hurt America on trade, it's going to hurt China. If China tries to hurt America on bonds, it's going to hurt China. These are all kind of strategies of poking yourself and the other person in the eye at the same time and just hoping that you have a higher tolerance for pain. Whether China has already done that bond trick in the last week, I guess we will find out in the near future. Whether they do it again, we'll have to wait and see. But the other thing to note is that America is currently very reliant on China for rare earth metals. Right? There's a bunch of very rare resources and minerals out there that aren't made or processed in many countries. And these rare earth metals is one of the commonly mentioned ones because it's used in a lot of electronics and military sort of hardware. And America imports a lot of this stuff, and China, I think, processes 80% of all rare earth metals. Don't quote me on the exact number, but a very high percentage. America produces some rare earth metals, but nowhere near as many as they need. So they rely on imports. And China has done this before. They've done a go slow on selling rare earth metals. Now, that's a potential way that they could respond. Whether they'll do it, I don't know. And remember, if they do it, they're going to hurt themselves as well. I mean, this is the problem with all of this, with the trade restrictions, with the debt games. with the potential restriction on exporting sensitive materials, they're all going to hurt both sides. So if China just say blockades America for rare earth metals, for a while, the Americans won't be able to produce their military hardware. So, I mean, that would be a vulnerable point, but they will start diversifying. Right? They're not just going to sit there going, oh, whoops, we can't build our military hardware. I guess I'll give up. They will start diversifying. They will start mining. They will start sort of encouraging, they'll start offering top dollar for countries like Australia to increase our rare earth metal production, which we have. Like, we're also one of the few countries that exports a decent amount of rare earth metals. America will find a solution. And if they find a solution, it'll take a few years. It'll hurt. It'll sting. But if America finds a solution, then now China can't sell their rare earth metals for the same that they previously could, right? So then they'll have talked themselves out of a market. So it'll hurt China as well as America. And that's why I think they're both some sort of, this is all brinkmanship, right? Everything they do is going to hurt themselves and the other country. This is Xi Jinping and Donald Trump in a dick measuring contest, like in a staring contest, hoping the other side blinks first. Everything they do to hurt the other side hurts them. And they're just trying to work out who can tolerate the highest amount of pain and how can you increase the other side's pain acutely right at the moment, so much so that they tap out because you want them to tap out because you're in pain as well. So that will be an interesting thing to watch now that it's just a US China battle. Keep your eye out for what China does on bonds and what China does on rare earth metals. And we'll come back and discuss it another time once we know more on that. So, Lyndon, I know it's not quite what you asked, but thank you for triggering a whole series of thoughts. This is a good point when I talk about money going in and out. So one way that I said before that the total amount of money flowing out of a country equals the total amount coming in, either through the current account, i.e. through trade, or the capital account through buying things. And one of the things, as Max here points out, that foreigners could buy is they could come in and buy housing stock. And if we have, so housing stock isn't just an investment product, it is itself a consumption good for the people living in the house. And if we've got an inelastic supply of housing, and spoiler alert, we have an inelastic supply of housing, which is a wanky way of saying we don't build houses quickly enough when people need them, then if foreigners are coming in, buying houses and potentially leaving them empty, then this could be a problem. The solution in that probably isn't to, perhaps we should cut back on foreign investment, right? I mean, I haven't even really touched the pros and cons of that argument here. But for sake of argument, for the moment, let's say we don't want to do that yet. You could still just cut back on this specific type of foreign investment. And I believe both major parties have to look. I believe foreigners outside the country already couldn't buy existing houses, except in some very specific examples, and maybe just decreasing the number of people in the country that can buy the houses as well. Realistically, the foreign investment in our housing isn't the thing driving our housing increase. It's that we've just got more people in the country. All right, so there's three things: more people in the country, not building enough houses, and every bloody man and their dog wanting to live close to the same 5 cities, right? Or wanting to live close to the same areas. So those are the things driving our house price rather than the foreign investment, because a lot of foreign investors already can't buy our houses. But yes, you are right to note that any sort of foreign investment would count on the capital account side. And look, there's a whole conversation should be had about the relationship we want with foreign investment, because there's clearly some upsides, but there's not only upsides, right? So there's it's over an hour now, and it's not really what I wanted to dive into. But I'll just say, firstly, the obvious upside is there'll be some businesses that don't exist without foreign investment, right? I mean, so some businesses need money, and the only way the money exists to invest in the business is to get foreign money, right? If there's just not enough domestic money, if there's not enough domestic savings, it can't be used. So there are some investment opportunities that would not go ahead without foreign investment. So that's an upside. But there are downsides too. I mean, one of the ones to consider is if you can borrow money cheaply overseas, that keeps our interest rates low, which I guess is another benefit of foreign investment. It keeps our interest rates low. And a lot of people like low interest rates, especially if you have a home loan. All right. But there are downsides to low interest rates, and one is that it doesn't incentivize much domestic savings. So there is a potential case to be made that perhaps we are losing out from not enough domestic savings, and maybe a bit less foreign investment would bump up the interest rates, which is, I guess, a very politically difficult thing to say you want to do. But if you bump up those interest rates, you'd bump up your domestic savings. You'd miss out on some investment, but more of the investment that happens would be fully Australian owned. So that's a trade-off, right? I mean, and that is a trade-off worth discussing. It's not what I was trying to discuss today, but it is a trade-off worth discussing. But I'll just note that when I was raising the issue of the foreign investment, I wasn't trying to argue for or against it. I was just saying that if you're leaving foreign investment the same, tariffs won't cut your trade deficit. That was the point that I was making there. Right? If you want to cut your trade deficit, you got to decrease foreign investment, and that will cut your trade deficit. But if you don't touch foreign investment and you just put on tariffs, you're not fixing your trade deficit. You still have your trade deficit. You'll just have fewer imports and fewer exports, higher prices and lower wages, and the government gets a bit of revenue. Right? So you just have a slightly poorer people and a slightly richer government, and you won't have fixed your trade deficit. If you want to fix your trade deficit, tariffs have nothing to do with it. You need to cut foreign investment somehow, or increase more outward foreign investment from your country to other countries. So increase domestic savings somehow, compulsory domestic savings, which we kind of have in Australia. But anyway, the point is it's a capital solution if you want to fix the trade deficit. The tariffs don't just increase imports to fix the deficit. Tariffs decrease imports and decrease exports, therefore don't fix the deficit. But they do other things, which you might want. All right. I spent 3 years living in Cambodia and what was it? 12 years running an NGO there. I like the place. Did the Cambodian live in Australia? Just checking out the... will Australia be flooded by cheap goods? This is an interesting question. So one of the things I mentioned before, how imports impact exports. And so as a case study in that, we could just look at America. They just slapped on a tariff, and what happened? American dollar went up, exactly as you'd expect, right? They put on the tariff. They're going to have fewer imports, but their American dollar has just gone up, which means America is going to struggle to sell as much. Their exports will go down as well. But what happened? A lot of other countries saw their dollars go down. So Australia has seen our dollar go down, at least originally. I don't know if that changed much today when Trump backtracked. But our dollar going down means that we would expect to see foreign goods look slightly more expensive, and we'll be able to sell more exports. So that's the nice part there. What your question is probably getting at is if China suddenly has no other markets, or they don't, not no other markets, but if they've just lost 15% of their export market, which is what America makes up, about 15% of China's export market, where are they going to put those goods? They'll look around. They've got to put them somewhere. If they're going to send them to us, we're already buying whatever we need. So if they want to send us more, they're going to have to drop their price. So yes, it's possible that China will try to drop the price of their products to be able to sell them to other markets. If those tariffs maintain, what China will do is just switch what they're making. So they'll shut down some factories, reopen other factories. There might be some really good specials you can pick up over the next 6 to 12 months. If you're shopping on, Shine, or what are the other, Temu, or those places, there might be some really good sales you can pick up of products that were intended for the American market, and suddenly they have to just dump them somewhere, and you'll be able to pick them up. I don't think that'll sustain, though. And also the other thing is, if our dollar stays down, that'll make imports look slightly more expensive for you. But it's good for our exporters, right? And that's exactly what you'd expect. America introduces tariffs that hurt our exports to America. Our dollar adjusts to make it easier for us to export elsewhere instead, which is exactly what you'd expect from normal trade adjustments. Why am I not running? I've taken a step back from retail politics at the moment to do broader commentary. I still help lots of people in the background, including some of my good libertarian mates, but I'll also pass on good ideas to anyone who asks. So good luck to them. Good luck to Craig Kelly in New South Wales, and I look to all of them, Jordan, and a bunch of names are escaping me now, but good luck to them all. But no, I'm trying to take a step back from retail politics and just do just general economic low tax commentary for the world. Hopefully that can be, look, it'd be great. Be great if the libertarians basically already have the tax policy that I would like, because to some degree I wrote it back in the day. But what would be ideal is if I could then sell the low tax policy to the Clive Palmer mob and to One Nation. One Nation, of course, already has some of the tax policies that I agree with as well, like income splitting. And then let's sell it to Family First, and let's sell it to the Liberal Party. Let's sell it to all the parties. So I want to get all of the parties on a small government, low tax, sort of tax cutting, low regulation agenda. And so to do that, I want to be able to speak to them all. So I'm not wearing any specific stripes at the moment because I'm just trying to pitch low tax so everyone will take it. Just checking any other comments before I wrap it up and sign out. Don't think China will exist. Well, spicy. China has a lot of problems. I mean, that's it. The tricky thing about geopolitics at the moment is that every corner of the world has a lot of problems. I mean, China's population is decreasing. They've been overtaken by India as the most populous. India is the most populous country in the world now. So China's population is decreasing. China's got a bunch of bad debt on the books that they're basically hiding at the moment. Now, maybe they'll just write it off and sort of print money to cover it up, and maybe they can make up for it later if they've got enough productivity. But I mean, their productivity is also decreasing. So they're walking a tightrope at the moment. They've got a bunch of very inefficient SOEs, state-owned enterprises, government businesses. And a lot of those SOEs aren't making money, and so they're just living off debt that is hidden off the books. And yeah, at the same time, their population is shrinking, and now apparently they're in a fight with America on trade. So they've got a tricky time ahead of them, but so does everyone. I mean, America's government debt, as we said before, if China spikes the bond market, that's going to increase the interest payments America has to pay on their debt. And America's debt is eye-watering. It's become not a political issue anymore because for some reason, just no voters in America care about it. If no voters in America care about it, politicians, it makes no sense for them to care about it. I imagine no one's going to care about it until it implodes. I mean, it could be that the bond market, the bond yields going back up, the bond market going down after Trump's announcement. The reason that might have been so scary is could this be the moment the world stops seeing US debt as the safe haven? If that was about to indicate that, then you could see why Trump would run screaming in the opposite direction, because that will be one scary day. You say you don't think China's going to exist in a couple of decades. If the world quote goes suddenly off the US dollar, what's the bet on America existing as a combined country in a couple of decades? Look, and to be very provocative and make sure I'm never invited back to China, well, America will invite me back. I think there's a lot of sense in both those countries splitting up into several different countries. Now, I know that seems weird today because everyone's used to the countries looking like they do. Countries used to change in size all the time. I think there's space for several different countries in both USA and China, but don't worry, China, I won't actively do anything about it. So, please don't kill me. And a question here from Rick. Now, I put these questions up before I read them, so I could be in trouble. Do you think regarding foreign investment that China particularly will set up manufacturing here with a specific purpose of exporting to the US at our 10% tariff? Well, I mean, that China already puts a lot of foreign investment into Australia. I don't know exactly that that's going to look super different. I mean, things like that happen. So they might do it, but to some degree, remember, a lot of people want industry in their country because industry in their country builds things and employs people. And pays tax, and there's lots of spillover. So if China is putting their business in Australia, then they're not going to get all the returns on the capital. They're going to get zero returns on the labor. They're going to get zero returns on the land, and they're going to get zero of the tax. So they get a hell of a lot less benefit from setting up a proxy business. Now, the individual owners might do okay, but those individual owners could already do okay, right? They don't have to set up the same business in Australia to do that. They could just go and buy shares of BHP, which is traded on international stock exchanges right now. So will this mean more Chinese people invest in Australia? Perhaps. If they're investing less in America, which they'll invest, well, they don't even have to invest less in America. Money's fungible. So, but if they do invest less in America, then I guess they'll invest more here. But I don't think the thing to look for is them literally just picking up a factory and moving it to another country, because they miss out on a lot of benefits from the factory. Remember, America right now, they complain about offshoring. They say an American business is now producing overseas. That's the thing that makes Trump angry. It's so China doing that now is China's going to be offshoring. I don't think the Chinese government's sitting there going, yes, we can offshore. I mean, they'll have some of the same concerns that Trump does. You don't want to send your factories offshore necessarily unless you have to. And people already have the capacity to just invest in factories that are overseas. So yeah, we might see some of it, but I suspect it'll be a bit more indirect than that. All right, I don't know what this comment is, but let's have a look. Interesting. Well, I can't comment on what they were doing. I hope it's being rented out if they're not living in there. Pretty Flash Canal. They were going to demo to build a new. Does that get you around it? That's interesting if they get you around it. Look, the thing to keep in mind, if foreigners are buying a house and not living in it, then the thing to look out for is whether the house is being left empty. Because if the house is being left empty, then what's effectively happened is there is one fewer house available for people to live in, right? And that's a problem. And what you can do, and this is already done to some degree, and maybe we can ramp it up. I haven't looked into the details of the next steps to take, but you can take steps to drastically increase tax on houses that are left empty, right? And that gives people the incentive to then rent those houses out, right? Don't leave them empty long term. If they're not left empty, then a foreigner buying a house, it might make it harder for you to buy the house, but someone's going to live there, right? The fundamental imbalance here is the total amount of people needing to live in a house and the total amount of houses that exist. And a foreigner buying a house, it might be a bad thing. I'm not saying we should invite them all in to buy the house, but that doesn't change the amount of houses that exist or the number of people living in the house. And that's the fundamental thing. We've got too many people trying to live in not enough houses. And it matters who owns those houses. I'm not saying it doesn't, but what we need to address is how many people are trying to live in the houses and how many houses are being built. And addressing other things is kind of just pandering and posturing, in my opinion. I mean, this is a total segue from what I was supposed to be talking about now, and I'm well over time. But I do wonder whether how much it matters that we have increased family breakdown. I know I'm sounding like such a boomer now, but we've got our house building is increasing at a faster rate than our population, but our demand for housing is going up, and that's because the number of people living per house is decreasing. Now, some of that could just be preferences. Some of that is just people having fewer kids. I wonder to what degree that family breakups are causing a family that used to require one house is now requiring two houses. We've got fewer people getting married and more people getting divorced. That just means that the same number of people that used to exist in one house, increasingly existing in two. Now, I know that's not the core of it, but it might be the core of it. I mean, maybe any researchers out there, dive into that one. But yeah, the two issues are not enough houses and too many people trying to live in the houses. So if you're not addressing one of those two things, then you're not really addressing the underlying problem. So anyway, that was a bit of a detour. Maybe I'll do a deep dive on that, the impact of marriage and divorce rates on house prices on another time. But the issue look, I didn't even get. All right. Well, I'm going to point to this. I'm going to point to it because I found it interesting, and I want to point you guys to it. But this is to wrap up on the tariff side. So Trump, tariffs, and trade, the three T's. Yes, this and welfare to stop family breakups. I know it sounds callous and cruel, staying together because you don't want to starve, but it's something that I think is very true, but I haven't got time to defend at the moment, so I'll just wave my hand and keep going. But anyway, on Trump tariffs and trade, a lot of the stuff I touched on here was in response to this wonderful stream of stuff from George Christensen. Now, I've got to say, I like George. I think he's good crack. I think he's good on most political issues. I think he's just a lovely guy as well. So none of this is meant by way of snark or having a go. He's a well-known figure who's on this issue I disagree with, so I thought I would have some back and forth with him. I've invited him to come and chat on this show anytime, and hopefully he does. But he ran through a few issues here. So you can go and find George Christensen on X with Nation First Ost. So Nation First AUST, as you can see on the board here. And he posts a lot of good stuff there. So you should check it out. But on this, he wrote a string of stuff here about tariffs. Tariffs protect workers. So look, I've responded to this as well. You can go and find mine at John Humphreys 99. But I think there's a few things here to address. Tariffs protect workers. They only protect workers in import competing industries. They hurt workers in export industries. They rebuild industries, yeah, in import competing industries, but they hurt export industries. So this is why I've stressed that so much today. It's the big thing people are missing. This one I find crazy. The idea that tariffs don't tax the country that introduces the tariffs. No more taxing Americans. Now foreign exporters pay to access our markets. I don't know if you guys have heard this one before, but the idea that foreigners pay the tariffs. The argument here is, it's technically true. The importer, which is often not a foreigner, but put that aside. The importer literally pays the tariff. But then in nearly all instances, what they do is pass that on as a higher price. Just like sales tax, GST, you don't literally pay the GST. Literally, the business passes that money to the government, but you pay it in the form of higher price. Right? So this has been understood by everyone up until a week ago, when suddenly people started stealing weird lefty talking points. But the tariff is paid for by the consumer in higher prices. But think about, if there wasn't a higher price, it wouldn't do any of the protection that George wants. Right? I mean, how does a tariff protect your local industry? Remember, he just said it here. It protects workers. It protects industries. How? I mean, if the imports come in and they're no more expensive, right? If the foreign country pays all the tax but doesn't change their price. So, and then this would make this point true, no more taxing Americans. If that's true, that means the imports are the exact same price. There's just as much foreign competition. So it doesn't create any of the protection. So there's an inconsistency between these two lines. Pick one or the other. And then this one, it's going to, what will Trump's tariffs do? Generate billions. Well, if you cut the imports by as much as Navarro wants to, that's the trade advisor to Trump, then it's not going to raise much money. Right? I mean, a 5% tariff would probably, raise quite a bit of money. And as that tariff gets higher and higher, at some point it's going to start raising less money, like the Laffer curve on tariffs. Because as the tax gets high enough to stop the trade, which remember is what George and Navarro say is the goal, to stop the trade. As it stops the trade, then you don't get any tariff revenue from the trade that doesn't exist. He says here, cut the trade deficit, as we've discussed in depth in this chat. It just doesn't. It decreases imports and exports, unless you want to do something about the capital markets. But that's not a tariff issue, right? So you could abolish all tariffs, and if you did something about the capital market, you'd reduce the trade deficit. Or you could quadruple tariffs, but if you leave the capital market the same, you don't touch the trade deficit, right? So they just fundamentally don't understand the cause of the trade deficit. This is a true point. America and Australia didn't used to have an income tax, used to fund the government on the back of tariffs. It's worth remembering. I'd love it if we could do that again. But it's worth remembering that back then the government was 80% smaller in Australia. I don't know the exact number in America, but it'd be something comparable. But 80% smaller. So yeah, if we've got a political consensus to cut 80% out of the budget, then let's do it. I will accept whatever tariffs that have to come my way, because if we can achieve that outcome, then that's trade-offs. I'm willing to trade off. But I don't think George would be willing to even go public with the idea of abolishing the aged pension and abolishing Medicare and halving defense spending and everything else that would need to be done to make those cuts. But if he did, then we're on a unity ticket. Let's do that. Let's cut spending by 80%. I think this is a bit naive that no free speech, any country that has complete free speech, I don't think that's going to happen. Anyway, so this was George's post. This was my response to it. As I said when I introduced this, I like George, but I think some of this is wrong. Tariffs protect import competing industries, but they harm export industries. This is the point I've kept stressing in this session. Export businesses tend to pay more than import competing businesses. So lower wages and higher prices. And of course, the tariffs are passed on to American consumers as higher prices. That's the whole point of the tariff. Tariffs cause an increase in imports and exports, so they don't do much on the trade deficit. And this is the point about countries used to rely on tariffs. That was back when governments were 80% smaller. To literally get back to that size of government, you would have to abolish Medicare and aged pensions and federal government funding for hospitals and a lot more besides, right? I mean, so it's seriously outside of the Overton window at the moment. So, but it's a nice thought experiment. And George repeated this really weird point that Navarro likes to talk about, saying that a GST is some sort of trade restriction. Of course, the GST applies to imports into Australia, but it also applies to Australian goods. So where's the trade restriction? I mean, it's an oddity, that point. Obviously, GSTs aren't a trade restriction. But anyway, I look forward to seeing George's rebuttal or else having him come in here and join us at some future day. Oh, by the way, I'll put that invite out to any of the critics. If you're sitting at home throwing tomatoes or shoes at the screen saying, no, there's a really great argument for tariffs that you haven't considered, get in touch. Please send me an email, jhumphreys@taxpayers.org.au, or get in touch via the website, or just send me a message on the social media. Find me on YouTube or X or Facebook. Send me a message. Maybe we can bring you in to discuss what I've got wrong, or you can just educate me via message. I'm sure it'll come along with a free personality assessment, as so many random messages do these days. But I just check the last messages. I see some more coming in. I might just message those people privately, because I keep dragging it out if I keep doing that. So we're coming up to an hour and a half, so I am going to nix this. Thank you for those who have tuned in. You may have noticed I didn't say this at the beginning, but like I say, live broadcast, make mistakes, you get to see them live. As you'll have noticed, I kicked this off at 7:30. From my perspective, I always did this at 7:30, because I've been broadcasting this from Queensland time. Daylight savings has ended in New South Wales and Victoria, so I had a decision to make. Do I do 7:30 or 8:30? I've gone with 7:30 for this time. Give me feedback if you think I've done the right or wrong thing, but 7:30 might be a bit easier for most people to access, so I thought I'd give that a go for now. But 7:30 ATA live. You can find Australian Taxpayers Alliance at this website, taxpayers.org.au. If you like what we do, go and have a look around the website, check out the campaigns. If you want, please consider becoming a member. But if not, just following us on the social media does a world of good. It really helps us keep going. So please go and find us on the social medias. You can find me personally as well at John Humphreys 99, or on Facebook, it's john.humphreys.australia. And we do this most Mondays and Thursdays. You'll note I wasn't here Monday. I was off camping, with the kids. Good fun. But most Mondays and Thursdays, 7:30 p.m. now, East Coast time. So tune in. I'll see you next time. Thank you. Thank you for joining me.